together, we have a good model and roadmap of the usual direction of the market, not necessarily every week or every month, but it tells us the direction. The red line has been, for the past 4 years, the more or less direction that it was telling us it was going to go, and the blue line is the actual S&P as of a couple weeks ago. And even this quarter, it did predict for a more of a correction in Q4, and we haven't really had it yet. Maybe we will. But the interesting thing is what's likely to go forward. The model here is the blue line, and the red line is the S&P. It's telling us that after this maybe another kind of year-end, a little bit of rally, in 2014, sometime maybe in Q1, the market starts to go sideways or correct a little bit. And then the important thing is towards the end of the year, re-accelerate and start to go higher again. And that's why I said secularly I'm more positive. This isn't necessarily bearish. It's actually, I think, bullish, because the sooner that we consolidate these big gains we've had, the better the long-term outcome. The market just continues to go up and up and up. Chances are we're going to have another nasty correction, which we don't want. So I'm more happy to think that the market might be plus or minus 5 or 8% next year, which is okay compared to the 25-30% that we've seen, at least in the US. And I'm just highlighting a couple possible reasons why I think this might occur, and I'll talk about a few of those in a moment, especially earnings expectations, which I think might be a bit too high. And that's key, and I'll show you why. We know that the tapering issue is not going to go away. I said that might not be a big problem, but I'll explain what the market's thinking, because it's very psychological. And again, after 5 years, very few times we've had 5 years of straight positive action without the market taking a little break. China is going to stabilize and start to do pretty well, as has been recently in the past couple of weeks or so, which is a bullish sentiment for the entire region. So let's just look at that for a second. This is, as of 2 weeks ago, the Shanghai comp. And there's a lot of lines here. So the red and blue, this is the index. The gray line is the PMI, which, as we know, had a kind of a cyclical rally the past couple months. But this is kind of the long-term downtrend that prices have been in. And it's been in a range the past 2 years or so. And that range is still very much intact today. The real action hasn't been here, it's been here. It's been in the small mid-cap section, which is a lot of the consumer stocks and some of the energy, smaller and clean energy. And hence, you can see the difference in performance between the three sectors and groups, which is quite interesting. So the large cap, as we know, banks and oil companies and telcos are down here. And the growthy type companies and the consumer-led Fed companies are the ones that perform the best. Since this sell-off, which was before the Beijing plenum a couple weeks ago, they've picked back up again. And that's probably a buying opportunity. So I'm fairly confident that these types of companies are going to continue to do better than the mega large cap stocks. Although I think there's a floor right now built into the large cap stocks. I don't think we're going to see another big down leg like we saw beforehand. The valuations obviously have been very low for these type of stocks, and they've been rising quite a bit for here. So again, the risk is now we need to see earnings growth really come through to think that this can continue. So that's a key component for 2014, to see earnings profits increase. It's a long-term chart of the 10-year US dollar government yield, which has been falling, as we know, for 30 years. And as disinflation has really impacted yields going down and prices going up. And that really accelerated here in 2008 when the first bout of QE came in, and it culminated in yields finding a low point last summer. And since then, they started to normalize and go back up. And then, of course, that big bar is when tapering in May came into the terminology, and we had that sell-off. And yields went up to 3%. And in September, everyone believed that they were going to start then, and it didn't happen. And yields fell back down a little bit. And now they're trying to rise. My hunch is between now and 12 months, we're going to go up in between these two lines, and we're going to be somewhere between 3 and 4% before next year.